Hey guys, Toby Mathis here today, and I've got two guests on today, Jeff Mason and Chris Hammond. Welcome, gentlemen.
Thank you, sir.
And we're going to be going beyond the 401k, and we're going to be talking about plans where you can put in over $100,000 a year and why it's important that you know about this. This is not a secret in certain communities. It's just a secret out there in the world in general, but in certain circles, it is certainly understood and utilized very effectively, and that's using defined benefit plans. And so, gentlemen, if you're willing to, maybe give me just a couple minutes on who you are and what you guys do.
I'm Chris Hammond. I'm managing director, co-partner with my partner, Jeff Mason. And we own and operate an actuarial firm that specializes in cash balance plans, which is a form of traditional defined benefit plan that kind of couples with 401ks and hybrid type. And we consult and administer plans all over the country. And we have actuaries in multiple states. And we basically consult and help business owners save massively on taxes. And we take a very unique approach to how we structure a cash balance plan for business owners.
Jeff.
Yep. Like Chris said, I'm the managing director as well at Redwood Retirement, and we like to, like you said, I like to take this hands-on approach with our clients and guide them through the tax burden that they have with using the tax strategy of a cash balance defined benefit plan and managing their cash flow and not. I don't have to be pushy about this. This is about saving taxes. So we love that hand-holding approach to how we deal with people. So,
and let's demystify it. So if you're listening, you're probably going, okay, what the heck does that mean? It means that we can contribute into a tax-advantaged account, which means you get a deduction this year, and you can contribute, in some cases, over $1 million. Generally speaking, probably in that $100,000 to $300,000 a year range. And I'll let these guys go over what those limits are and how you calculate it. But I'm not joking. You could be making $200,000 a year and you can contribute pretty much the whole dang thing into a retirement plan by working with an actuary. And an actuary, gentlemen, does somebody want to take a crack at what an actuary is?
Well, we're basically talking about, we call this a pension plan, right? So back before the current state of things, when a pension plan was all retirees had to rely on, they worked at a company for 30 or 40 years, and the company gave them then an ongoing income stream for life after that, right? And so what an actuary does is basically say, okay, well, we have all these employees, this workforce and owners. What kind of benefits are we talking about? How long do we have to pay them for? So an actuary is basically looking at mortality and interest and financing and discounting to project what is that income stream and liability stream going to look like for the next several years or decades, especially with very large corporations, right? In modern times now, we're talking about small business owners, doctors, dentists, chiropractors, lawyers, engineers, successful small business owners in any trade, really, that are looking, how much can I accumulate in a very rapid period of time while still providing benefits for my employees? And the more I provide my employees, the more that it allows me to put away as well. And if you're in the unique situation of not having employees,
there we go.
The rails are off. There's a lot you can do. There is a limit. We're going to show that. But basically, an actuary is someone that is well-versed in the mathematics behind these things. These are very complicated under the hood. No one ever has to see it. We work with the actuaries directly. We direct them and consult with the client and basically get down to what's going to work for your situation.
So let's say, so Jeff, I'm going to ask this of you. So let's say that I'm making $300,000 a year, and I've done this for a long period of time. Maybe I'm 15 years, 20 years into my career. I'm getting older, and I'm like, I don't need to have all that money every year. I already have some savings. Maybe I've got some real estate. Maybe I've got some other investments. What's a typical range of how much I could put aside tax deferred? Like I'm going to get a tax deduction for this, but let's say I'm making $300,000 a year, 50 some years old. What's a typical range that I'm going to be able to put aside?
Individually, you're probably 200,000 all the way up to 350, year after year, and if you wanted to in a really big year, you could put in quite a bit more than that. I have two quick analogies that will kind of explain what a cash balance plan is. So Chris and I have broken them down to two very easy analogies. So first one, let's think of it as a savings account, right? So when you go to the bank, you ask yourself two questions. Well, how much am I going to save and how long is it going to take me to save it? So let's say we're going to do $1 million over the next 10 years. So our savings account would be $100,000 plus some nominal interest, because that's what the IRS requires with the cash balance plan. And so each year we'd put $100,000 plus nominal interest. So if we design it correctly, maybe we put in $300,000 and we get ahead of our savings account. And if the business owner's having a down year and a low tax liability, maybe we only put in 50. That way the savings account can complete itself, but we're still on track. So the design in the front end is very important.
Yeah. So I don't want to interrupt you, but we're targeting $1 million. And so you just said 300,000 might be the first year. So let's say, hey, we need to hit $1 million. And
Yep.
you don't have to put in 100,000 a year. You could put in 350,000, 75,000,
Yep.
200,000, 100,000. Like you could actually space it around, and that's pretty flexible.
Yeah. So there's some limitations to that. So that's the second part of the analogy is, now let's think of the cash balance plan for the business owner as a credit card. And so that credit card is going to hold the savings accounts from the last analogy. So then each year, just like you get your credit card statement, you're going to have a minimum due and a maximum credit card limit. For the cash balance plan, you have a annual minimum due and a maximum deductibility for your company, the company that's sponsoring the plan. So just like when we're having a good year as a business owner, what do we tend to do? We tend to pay our liabilities down. So you would pay more on your credit card. You probably pay closer to the maximum limit for that year. And when we're having a down year and a lower tax liability, you're going to pay probably closer to the minimum to control our cash flow, right? And so that's exactly what would happen in your question is like, so if someone wanted to put in a much larger amount, we're going to give them the range for their credit card statement each year. Obviously, the opening year, we know exactly what we're doing, right? Because we're designing it from the beginning. So yeah, we can project that for them, where most firms don't take the time to do that.
And so this is just so we're clear, because you're saying paying a credit card, you're paying into your retirement plan, and this is where people's brains break. We're so used to, hey, I could put $7,000 a year in an IRA, or I could put $23,000 a year in a 401k. This is the same thing, ramped up. And instead of calculating how much we put in, we're calculating how much you can build up and receive based off your income. That allows us to hit a certain dollar amount. Now, Chris, maybe you could elaborate on that. There's a cap.
Yeah, that's exactly right.
There's a cap, right?
Yeah, that's exactly right. So the credit card analogy is that unlike a 401k where you're just contributing, a defined contribution, this is we're designing the benefit. We're saying we're going to give Toby a benefit of 100,000 every year for the next 10 years. You haven't put a dime in yet, but we know we've got $1 million liability that's going to accrue over the next 10 years. And so to Jeff's point, as a credit card statement, and again, back to the actuary, what the actuary is doing at the end of every year is he's balancing where do assets stand based on contributions and investment returns versus that liability that we designed. And based on that, it creates this minimum to maximum payment range. And so we like to explain to clients, because they get their brain scrambled by that. But when you say it like that and they understand, so this minimum you're always telling me about, that's like paying the minimum to the credit card. So I can do that because I have tight cash flow, but it's not really making progress towards that liability. Whereas if I'm doing great this year and my God, my taxes are going to kill me, but I could put 400,000 in and it's going to reduce my taxable income. Yes.
Now, if I'm a business owner, I'm sitting there, the first thing I'm thinking is, you just created a liability of $1 million. Do I have to pay the $1 million, or do I have flexibility? Do I have the ability to modify this thing? Am I completely toast? Am I having to pay this all the time, or do I have some flexibility? What are the kind of the guide rails? Maybe I'll throw this at you, Jeff.
So when we set up that savings account for each individual in the company, so let's just say we have a owner only, right? We have no employees, it's just the business owner. What occurs is, let's say it is $100,000. If we paid ahead, now that minimum could be zero, right? So if we put in 300,000 and we're tracking and we should be at 200,000, that minimum might be zero, but we still have a liability that we could fund into, right? That might not be the case in every situation, but that's where help forecast and show that, right?
So it's almost a pretend liability. It's like, this is how much I can put in. And so when you say liability, that just means here's what you can pay and deduct. Is that fair?
Exactly. And so as long as we follow the guidelines of the IRS or the parameters that we set when we design it, and then, yes, that's flexible. Every couple of years, we could change that. Obviously, the IRS is gonna put the no finger if you start going, dramatically up and dramatically down and stuff like that. We're going to try to stay consistent. We're hoping that we can start out somewhere and then maybe enrich the benefit. It's a lot more fun for everybody when you do that. But
okay,
so another way I would say it, Toby, real quick, you stimulated another analogy here. Think of this 10-year analogy and $100,000 a year as hurdles. So yes, we're projecting that if that's the design that's comfortable for the business owner today, that's what we're going to lay out. Halfway down the lane, they might say, you know what, I need to put in a lot more, or, oh, that was too rich for me, I need to pull back. I've lost a big contract. We can pull back. We can adapt as we go. But so the liability really is, once you go over each hurdle, that liability then is locked in. Does that make sense?
Yep.
So we're looking at $1 million, but you get through year 2, you've really only accrued 200,000 or whatever we've designed, and you're paying that. Now, even then, there's flexibility. You want to fund because you're saving up for retirement. You're trying to take this tax deduction, but even in a bad situation like when COVID hit, everybody went, "Oh no, now what do we do? Restaurants are closed. We can't put any money in. We have no cash flow." Well, if you close the plan, if you have employees, the employees will get 100% of that liability that was built up for them. They'll get paid first. The owners take the hit. And it's not that they've lost anything. They just, maybe they're 700,000 liability at that point, and they're only at 500,000 in assets, and they have nothing to fund. As long as they meet the minimum for that year, which is crucial, they can say, okay, we're going to close this. We won't get our full share. We'll take what is remaining that goes towards us. They're able to waive their liability at that point, as long as they've met all the yearly minimums.
But if this is a closely held company with 2 people in it, you're not worried about that. This is if you have a bunch of employees that you're contributing as well, right?
Yep.
And this is a benefit for those employees too. Like, it might be that you're getting 90% of the benefit and you're giving them 10, but you are giving them a nice retirement benefit, and it is deductible, right?
Exactly.
And is that pretty close? Like, what's the benefit that's usually going to the owner? Like, what's the range that you generally see? Is there a magic number that most people want?
Yeah, or for his contribution or percentage back to them.
Percentage back.
Percentage back is I'm always shooting for 90% or more, right? And if you have a lot of employees, that percentage is going to go down naturally, but that's my goal. And usually if you have employees, if I don't get you to 80% going to the owner and family members, so typically, we add the wife or use the rest of the tax strategies available. If I don't have 80% going back, I'm pretty upset.
But if I'm putting aside, let's say that I'm putting aside, I'll just use a round number of $1 million. So this is somebody who would definitely have been hit at the 37% tax bracket. And they're like, oh man, I'm going to get 630,000 that I'm going to get to keep after the Uncle Sam takes this. You're putting $1 million into a retirement plan where you're getting 100% of it. And it's going to grow tax deferred for God knows how many years. And it's going to come out, it's going to pay tax. But that's going to be a sizable amount. Like, when you take a 37% tax hit, I forget what it is, but it's close to 60% that you got to make up for that tax hit. It might be even more than that. So you're way ahead of the game. You're just like, is that the right way to think about it?
Yes. Dollar for dollar. And we show this in our concepts designs when we're, scouting prospects for who this is going to help. We're showing them, here's our solution. Here's how it works. And if you want the proof, we have that too. If you were to stick the after-tax equivalent into a retail brokerage account and trade that instead, apples to apples, and even with variance, we can show how this is way better because of what you just said. But we show the effect of that pre-tax deferral, Toby.
Yeah, and you guys are number crunchers, so you could actually say, here's what it is. But most people think, like me, I drag my knuckles. I'm like, all right, if I can write off 100 grand, I'm going to save myself 30. Right, I'm in 30% tax bracket, 30-something% tax bracket. It's going to save me 30-some thousand. So I'm I'm looking at it from that standpoint. Most people are probably going to do the same. So two big questions, and then I want to go through some case studies. The question number one is, when do I have to pay it? Like if I'm doing this for 2024, do I have to make all these payments in 2024 or do I have some leeway?
You have till 9 months if you're a corporation or any pass-through entity, you have 9 months after the calendar year if you're a calendar year company. So you have all the way to 9/15/2025 to fund a 2024. We still have 2023 clients that are opening up right now, and they're not due till 9/15 of 2024.
Okay, I want to explore that real quick. I can set this plan up even after the tax year. So if I'm in 2023 and I'm before September, this video will probably come out just before that. I could still set up a plan and actually make contributions for last year and lower my tax liability.
Yeah, absolutely. So if you have no employees, we can go all the way to September 1st. We need some time to open accounts and get documents in place and all the signatures. If you have employees, probably like August 15th, probably is the general timeline. I know last year we were, you pushed me to some clients and we went right there on the deadline. I think we opened up accounts at 9/14. Yeah. That was one. It was owner only, and I think if he wouldn't have been out of the country, it would have went really quick. But
now let's just say that oh my gosh, so like I could be doing this for 2023 right up against the wall there. What if they've already filed their tax return? Are they toast, or can they still
no, they can amend. They can amend, but that's weighing the pros and cons of amending and doing that. But in some cases, it could make a lot of sense, especially
right
now it pushes them into QBI and other things, right? By utilizing it. So
it is a deduction, and so it does change some of the total tax calculation.
Mm-hmm.
Like that's why you have numbers people. They say, if I do this, what's the overall impact? And it sounds like you guys are good at that analysis.
I love to tell people what is the rate of return on when you write a check to the IRS. That's my favorite thing in the world. It's 0, right? And so when they're like, well, I have to put it in this account and I can't get to it right now, I'm like, you just got a 0 rate of return. I'm telling you, all that money is going to be in your name growing for you over time, and you'll get to it later. If you write a check to the IRS, it's never coming back.
Now, what are you guys putting this in? Like, is it just sitting in a checking account, savings account? Is it earning interest? What kind of financial instruments can we use when you open up?
So we're going to use normal qualified funds. So we're going to use, bonds, ETFs, money markets if needed for sitting that cash, and then stable value, and there'll be some equities. But we want something that's going to grow really slow. And then for our advanced designs, we're going to use life insurance if it fits for that individual, because obviously there's some parameters to qualify for cash value life insurance. But what we utilize this for is we can build Toby's favorite thing in the world, if you watch any video, is we can build an asset with this cash balance. You can actually fund a life insurance policy pre-tax, which this is. Yeah, so it's a beautiful thing. And then there's a mechanism to get it out, which might be too advanced for this podcast alone, but that's where we're gonna begin and open that window, right?
This is where it gets fun. So I imagine that you're manipulating the cash value to keep it as low as possible. And I say manipulating, I mean you're picking policies that have the lowest cash value in the beginning, so that in year 5 or 6 or whatever, maybe you're buying it out of the plan at the cash value marker, which is its fair market value. Now the policy's out of the plan, and now it really starts to hum. It's all inuring to your benefit, where you can get access to it through policy loans, not paying tax on it. Holy cow! So that sounds pretty tasty. If I'm an investor, wow, I like that. Let's shift gears here, just because I like examples. Do you guys have any examples of people that you've worked with, or favorite cases where it can be really hit home for people, where they might say, "Hey, that sounds like me"?
Yeah, I think we'll build one for you on the fly. In fact,
let's do it.
We'll do the Toby Mathis cash balance plan.
I still call them tax defined benefit. I have a bad habit. Are they the same thing, or are they different?
Cash balance plan is a defined benefit plan, but it's another class.
Yeah.
So a traditional defined benefit plan is structured a certain way. Again, looking at long-term liabilities, cash balance plan is a liability builder, like we've been talking about, but it is more of an annualized budget, if you want to think of it that way.
And then let me ask one thing. Yeah, you can pull up your screen. I want to see. We'll do this. Let's build one. But what's the most you have right now of somebody putting away per year that's tax deferred?
Well, we have the one client where we're put in $1.2 million for 2023. It was between the husband and wife who are very young and the mother. So
Oh,
it was,
wow.
yeah. So it was a game changer for them, tax wise, because they were sitting with a very, very large tax bill.
If I'm not mistaken, are you talking about like they're going to be in the top bracket? So I'm just going to get my calculator.
Oh, yeah.
Are we talking about tax savings of over $400,000? Just
Yep.
I'll take that action.
Yeah. And even better, that was last year. His max for this year, I may not let him go all the way to the max, but his max for this year is 1.7 million.
Holy kashmoli. But there's a total amount that they can put into these plans. Like these plans, I can't have a Peter Thiel Roth where I got $1 billion in it or 2 billion or whatever the heck he's
That's right.
accumulate. These things have this is the max you can have in it. And if not, bad things happen, right?
That's right. And this is one of our exceptional clients that just kills it in his business.
Hey.
And so when I do this first two-tiered example for you, I kind of interlace this story because it fits.
Let's do it.
But they're just in the situation where they're able and needing to contribute a significant amount. And between the husband and wife and mother with no employees, they have a lot of latitude where they're able to do that. And we have plenty of other clients that are also sticking in, 400, 500, 600, 700,000 in a given year, or even up to $1 million over a couple of years. And it's not all the time. It's not every year. I want to be very clear about that. This isn't something where we're going to tell you can put in $1 million a year and for the next 20 years, you cannot. But in the right situation and when it makes sense for you, business-wise and tax-wise, you have the latitude in this plan. Even if we give you a nice linear design to start with, you have the latitude in a given year to sock away 6 or 7 figures at times.
And what's the maximum amount? Like if I did this and I was a single owner, I'm in my 50s, what's the max I could put in this type of plan total?
The max that someone can do right now, it's based on a number of factors, but the max someone could do as of right now, the IRS does limit what you can accumulate in a defined benefit pension plan, cash balance pension plan, which right now is 3.5 million. If somebody is retiring today and they had that and their limit supported it, their individual limit, they could walk away with that amount. It's indexed, so it goes up every year. So the nice thing about our software that I'm showing here on the screen is we're actually projecting forward where that limit's going to rise to within reasonable assumption. And so we kind of know where someone 10 years out from now or 15, 20 years out from now, where that's going to take them. And so based on that, we can design around that outlier and then backfit it to what's going to be comfortable for them and suitable for them, with the flexibility added that they can go, like Jeff said, low years, they can contribute 0 to a very low amount, depending on how they're funded, how well funded they are, or to a very high amount if they are able.
Yeah, so this sounds like it's a good tool to have in your toolkit. And if you have a great year, or you're somebody especially that's had a great career and you're 15, 20 years in, 25 years in, and now you're like, shoot, I'm getting killed in taxes. This is a great way to say, you know what, for the next 10 years, I'm putting my head down. I'm not going to pay the tax man. I'm going to put it aside for myself. And I'll gladly pay the tax man over the next 25 years as I use the money in my retirement. Is that
Absolutely.
Okay. Let's go through an example. How do you want me to tell me what you need from me?
All right. Well, can you see the screen okay?
Yep.
A little blackboard here.
Yep, I certainly can.
All right. I'm going to walk you through kind of quickly. You can see over here I have a compensation list. This is looking out for the next 11 years of 100,000. And we'll come back to this because I want to illustrate some of the things we've been talking about. But let me first go over to the assumption page. Okay, so if we do a model of Toby Mathis cash balance plan, and we will do 100,000 in W-2 comp, It's important to note that compensation that's used for retirement plan calculations, if you are an S Corp or C Corp, has to be W-2. It can't just be your net income from the business. And so, unfortunately, there's a payroll tax component to that, but we're going to show why it's worth it when we get into this. So if we do years at 100,000 in W-2, let's say, we're talking about the next 10, 12 years, and we set the benefit at 100% of comp just to start. We're going to say that's $100,000 annual benefit like we were talking about, right?
Mhm.
So looking forward to the liability. And then that gets an interest credit added to the benefit amount. So the liability, like a credit card, is accruing at an interest rate, right? These are benefits you owe yourself. So that's why we call it your credit card, that you're going to end up funding toward that benefit. And so the idea is that you're going to match the investment return objective to that interest credit, because you're wanting to fund pre-tax dollars into the plan to hit your annual benefit. And then you're wanting your investment portfolio to keep track of this interest credit that the benefit is growing by. Okay. And so what we're going to do is go over to the blackboard here. I'm going to demonstrate that really quickly. And so just looking at the benefit real quick, that's this blue line here. So we call it the blueprint. We're still at day one, right? But we're looking here 11 plan years out. So 2023 and then the next 10 years forward. Okay.
Mm-hmm.
So this is a $100,000 benefit each year, growing at 3% on that accruing liability. All right. And so this is really just the blueprint. It's the target. This does not mean where we have to end up or anything like that. It just is the axis that everything's revolving around. So before we go further, let's step back, and I want to talk about the limit. Now, the first thing I want to do is go back to that assumptions page. And like you started out saying as an example, let's talk about like 300,000 or something like that. Let's do, in fact, the IRS allows, even if you're making 500,000 in W-2, they limit how much compensation can be considered in a given plan year.
Mm-hmm.
Right now, that limit is 330,000. And so I also want to make a larger benefit. So we're going to double this.
So when you're doubling the benefit, you're saying, how much am I putting into the plan each year? Am I putting in 330 or am I putting in 200?
So we're going to make compensation 330. The benefit's going to be 200,000 a year. So now instead of 100% comp, we're looking at 61% of comp for you.
Okay.
Okay.
So we're putting in 200,000 a year, right? So
200,000 is the benefit. Okay. And so now let's go back to the blackboard because I want to show the limit this way, this IRS grand limit, grand ceiling on what someone is able to do.
Mm-hmm.
So for you, looking forward out to a retirement age of 62, which is what we like to do, it can be 65. And certainly no one has to stop at those ages. They can keep going for many years after that. But we anchor it to this because going back to what does an actuary do? An actuary says, where do we need to be at retirement? And then discounts everything back to your current age.
Mm-hmm.
Okay. So based on that and projecting to retirement, we're seeing that 3.5 million that the IRS limits someone to right now, in 11 years from now, and based on 330 in comp and 10 plus years in the plan, you're looking at 4.2 million that you could accumulate, a little over 4.1 million you could accumulate.
All tax deductible. That's all tax deductible contributions plus some tax growth, right?
Yep. Right. And so what I want you to think about, and everyone watching, is this is not what you have in the account or what you will have in the account. This is the ceiling on what you can do at any point along the way. So if we build this and someone says, can you redo this and show me what it looks like at 7 years? No need. Slide back down the graph to 7 years. This is where you can be.
Mm-hmm. And that's the max that I can contribute for that period of years. So
if you got to year 7 here, you can see it says just under 2.2 million. If you got to year 7 and you had 2.5 million in it, for example, we need to wait another year until that limit catches up. So we don't mind, as long as you have a long-term outlook, we don't mind if your assets get a little bit above this red line. We don't want you way up in here because you're just inviting a disaster. But in the end, we don't want to exceed this red line. Everything above it invites a 50% excise tax and ordinary income. This is the most the IRS will allow you to take out of this plan when you shut it down. Okay. So at 62, we're talking about 4.2 million. Now, how do we get there? All right, we talked about doing a $200,000 a year benefit now. So this is the baseline. So if you said, I'm perfectly comfortable putting in the same amount every year, I'm perfectly comfortable with an investment return of 3%. And some people might say, well, 3% is pretty low. However, we can't exceed this red line. So if I'm annualizing 12%, what do you think is going to happen to assets?
These are assumptions, though, right? Like the reality
That's
is
right.
that you're targeting 3%, but you might be doing bonds that might be doing what, 4 or 5% right now.
You could be doing higher, you could be doing lower, and that all comes out in the wash when we do the actual calculations.
Yeah.
But what we don't want is someone to say, "Oh wow, Toby's putting in 200,000 a year. I want to stick that in Tesla or something," and all of a sudden your assets are way up here that you can never get to,
Yeah.
right? So we're looking for conservative returns, low volatility, because the idea is you want to be able to put 200,000 away. What if you put in 3 years of 200,000 and your advisor took you out and got you 40% returns? You're going to be way up here.
Mm-hmm.
And all of a sudden the actuary is going to say he can't stick anything in. So now year 4, 5, 6, 7, you can't put contributions in to take tax deductions on.
That's because based off of that growth, you're going to be at your max.
That's
so
right.
we can't contribute anymore. It doesn't mean that the plan's toast. It just means that you can't put more tax deductible dollars into it, right?
That's right. And you have a risk of paying excise taxes and ordinary income taxes, because if you take it out at any given point in time along this curve, you can't exceed this ceiling. This is what the IRS says is your limit. And it's different for everybody, by the way. It's based on number of years of participation in the plan, how old you are, how far away you are from retirement, all those kinds of things, what your average compensation is. That's a big driver. And so, yeah, we really are saying, you're talking about the 37% tax bracket. If you want to be able to put in multiple hundred thousands a year, or even up to 7 figures in some years, you don't want the returns robbing you of that opportunity, right? So when someone says, "Why is it 3% or 4% return?" That seems very low. Well, it's because we're getting the return in the tax deduction.
So when I look at it, I'm saying, hey, if I get a 4% return, but for every dollar I put in, I'm saving 32 cents in tax on, right? Then realistically, I'm getting a 36% return.
That's right.
And so if you're making $100,000 a year and you're in a lower tax bracket, then it may not be worth it, right? You don't want to go to zero. Right. You're probably what, closer to 200,000 or something, where it really starts.
The higher, you're 100% right. The higher the tax situation, the more this benefits you. It doesn't mean you can't benefit. You will benefit. Mm-hmm. But yeah, Nevada, 37% and 0% state, okay, that's not, it's high, but it's not terrible. California is 37% plus their state, which can be 11.9, 12.9, 13. They're over 50%.
Yep.
Right. So in an extreme case, someone in the top marginal rates in state and federal are going to benefit the most. Mm-hmm. But anyone is going to benefit from the pre-tax basis of this, just like in your 401k. So what I want to show, though, is going back to our blackboard here. So again, this is the credit card that's accumulating your benefit over the number of years, growing at an interest rate. Mm-hmm. The target of the investment is Toby's going to put 200,000 in every year, and you want the net return of your investment portfolio to closely match that. So let's just say it exactly matches that. So you can see now the green line is the actual assets in the plan. So in a perfect world, if we said we want 200,000 a year at 3%, and you did exactly that, obviously that's not ever going to happen. But if you did, that's what it would look like. Mm-hmm. Okay. Now, if you said, okay, that's great, but what if, like you said, your assumption is 3%, but what if my advisor put me in a portfolio and the alpha was pretty good and I actually got 6% instead of 3%? What does that look like? And is that going to get me into trouble?
What does that do?
Okay, not so much. I mean, you're above your target, which is good. The actuary is going to look at the plan assets at the end of the year, and they grew faster than the target was, so it's robbing you some, but you're not in trouble, and you still have room to fund more over time, above and beyond your target. So all we care about is developing a target that's comfortable for somebody, and then having a lot of room to give them that latitude if they need to fund a bigger amount in a given year.
So can we play with that? Let's say that right now I'm like killing it, and I want to put $500,000 a year into the plan. Is that possible to model out what it looks like then if I did it? Hey, you did 500 now, but maybe you're going to do 200 next year. Maybe you're going to do 100 the following year. Is that something?
So what I'm actually going to show you, it's a different example. I'll have to switch which one I'm pointing at here. But what I'm actually going to show you is, so in the end, you can see here at 6%, let's say we did, you're just under 3 million, but you can go all the way up to over 4.1. So you still have 1.1 of room here that you would like to fill up with contributions. And
So
right?
I can add to, I don't even have to go down in a year. I could just say, hey, I'm going to add an extra 300,000 for 4 or 5 years. And
As long as for that year, the actual calculations bore it out and said, because every year does have a max on what you can contribute, and it's based on a number of variables and the changing interest rates and all that. But that's what we're doing. Jeff and I every year are giving clients an illustration that says this year, based on where assets stand and total benefits stand, you must fund at least this, which if you're well funded can be zero and often is, and you are able to fund up to this amount.
Yep.
And so based on a number of dynamics, that range fluctuates. And so like we were telling you in a couple of those cases, we have cases where, yeah, it's 1.7 million for one of our clients right now after he put in 1.2 million last year. That's a very big case, but yeah, it shows that kind of flexibility.
But they're not going to be able to do that for 10 years, right? They would blow through the ceiling.
That's right. So you're really looking more like a situation like this, where you have a plan and you're kind of sticking to it. Maybe you're putting 200,000 in for the first 3 years, and then like Jeff said, you have a tight year or you have some other project you want to put your money into, and maybe the minimum affords you to put in zero that year or a very low amount. You don't have to stick to the plan. So and returns also can vary, obviously. So these lines the actual returns and such will shift, right? But yes, you still have all this room in years when it makes sense to do so, especially tax reduction wise, where you can put in larger contributions all the way up to the point where we could fill up this bucket. So when I put this red line on the graph, that's what I'm building. I'm building the bucket for that owner. Jeff is consulting that business owner and saying, where do you stand? Where do you see yourself? What's the long-term outlook? And based on that, we will size this bucket accordingly. So let me show you. We jumped comp all the way up here to 330, right? What if we didn't have that comp? What if we said, well, I like that benefit and it looks good, but I don't want to pay that much in W-2. I don't want to pay the payroll taxes and such. Here's going to demonstrate why that's so critical. Because now your plan fails. So if we only put 100,000 in W-2, for some people that might work perfectly, but for this situation, you wanted to put in 200,000 for 10, 11 years, you're not going to be able to do it. You crashed that ceiling right here.
And we're not talking like you could put the entire amount of your W-2. You just have the employment tax, which means old age disability and survivors, 12.4%. Medicare is 2.9%, total of 15.3%. Half of it's deductible, so it's 14.1% or thereabouts. But it phases out a portion of it. The 12.4% phases out at, I think, 167,000. It's indexed for inflation. So every year it goes up. But you have a portion that you're going to be paying employment taxes, but that's okay. Because in theory, you're paying into Social Security, you're going to get it back when you retire, right? In theory, you're basically funding your own retirement plan, although Congress spends the money, but you have a benefit that you're going to get. So that's the price that you pay, right? It's like, okay, I just have to pay it through payroll to fund this, but I could do this.
And here's the thing: the news isn't that bad, because you can, a lot of your clients, I'm sure, try to keep W-2 fairly well contained because they want that cash flow for other investments and other projects, right? So someone's saying, well, I want to keep my W-2 at 100 or even less. That's fine. Right here, it doesn't work, but you don't have to have that 330,000 every year to get that limit. Let me show you what the IRS does. The IRS says you're able to put in 330,000 in comp. It's this year one here. We have you set at 100, but it's 330 for 2023. For 2024, the limit is 345. So even if you made 500,000, a dentist has 500,000 in W-2, doesn't matter. We can only use 345 of that in this limit calculation and for profit sharing and other things. But here's what it looks like. We're indexing going forward. The IRS usually increases that comp limit about 5,000 a year, sometimes more, sometimes they don't, but usually. So in the next 11 years, we know that this is what it looks like. So if you took W-2 of these amounts every year, this is that limit you would get to, what we saw, 4.1. Same as if it was 330 every year. We saw that too, right? But no, you want to be at 100,000 a year in W-2, but you also want your bucket to be big enough to do this and have room for bigger funding in the future. In actual terms, we only care about 3 years, a high 3. And so here's what that looks like. When we do that, here's 100,000 every year, except for in this bubble right here. So here we need to we need to pump up W-2 in these 3 years, pay more payroll taxes, but you don't have to do it for all these years. Look, the limit's the same.
So what does that mean for a business owner? Does that mean like, oh my gosh, I'm going to have to, I pay myself 100, and now I'm like for 3 years, I'm going to have to pay myself $1 million worth of payroll?
If, like you said, that's the cost of doing this. If they don't, that's fine. But then they're limited to about 1.289.
But we can find a happy medium between that, right? So,
right.
So if they're really comfortable with 100,000, but let's say they could do 250 for that 3 year and raise their average, and so then
let's do that.
Yeah, so that will maybe they'll get them somewhere in the middle, right? It's a give and take, right? And it's about cash flow.
Would you say 200,000?
250, I said, but
250.
Yeah.
All right, we'll do that. 250. There you go.
250 works, right?
So now your plan works, and you have a little bit of room here because your returns were too aggressive. So if we back off the return, stick to what we told you. The goal is 3% because this is a tax deduction play, right?
Mm-hmm. So we're doing bonds or something, or we're doing something that just grows.
Now you still have room to over contribute in years when you really need to. And otherwise, you can just stay right on track.
Yeah. And so for business owners that are watching this, and your brain might be aching a little bit, going, "Oh my gosh, actuaries and lawyers, I think I'm going to stab myself." Right there, it's the point is that you have the flexibility. If you're going to fund this, you're funding it with payroll. So hey, I'm not putting $200,000 aside with my rental income. I'm putting $250 of my W-2 income, and I'm not paying tax on it anymore. The only thing you pay tax on are the employment taxes, which again phase out on a portion of it. Medicare never phases out, but you end up paying very little tax depending on what your other income is, especially if a high income spouse,
Right.
Or if you have another job, or you have lots of W-2, especially you folks out there that are making $600,000-$700,000 a year W-2. It ultimately, what we care about is scraping off the highest tax dollars that are at the higher end of your income and jamming them in taking a deduction on those and jamming them into a cash balance plan. Is that fair?
Yep.
Absolutely.
All right. Before we go, because I think we're a little bit over, is there a favorite case study that you guys have that you're like, hey, this is a really great case study. These people were doing X and what a great result we have. Man, they just killed it.
Let me do this because this really will help understand the case studies that have happened and why they got to that route to start with. Let's take you back to your limit here, and you're trying to fill this up.
Mm-hmm.
And what did we have? A 200,000. Is that it?
Yep.
That's the 200. Okay. So in this case, let's even get your return back up there because this is part of filling up the bucket, right?
Mm-hmm.
Okay, you're going to be able to fill this up if you're able to, because that's again what we like to tell people the most is this is their ceiling. They can fill the bucket up all the way with tax deductible dollars. But what Jeff and I like to show people what this is why is this so valuable? And so we show here what that actually projects out to for that business owner. And again, this 3 million, that's at 6%. That's that green funding line. It's not the red line. It gets much higher. We can take you all the way up to 4.1, for example. That equates to about a $236,000 income stream for life. So when you asked about a pension in the beginning, that's what it used to be. That's what that roughly equates to. And most people then, when they shut this down, they roll over into an IRA and manage it or have it managed. But here is an illustration of the effect. These after-tax dollars going into a retail brokerage account end up much lower than what this pre-tax does for you. And so what we show in a concept design, when we send a 2-page concept design for a given prospect is, what's the advantage of doing this? And in this case, without going all the way to your limit, you're at $645,000 better off because you did this. And the net tax savings is about $770,000. This is after all fees, expenses, taxes, everything. This is net. This is after, right? This is the 2.9 and you're walking away. And again, it comes down to effective tax planning, but That's what we're looking at.
Mm-hmm.
And so for those cases that we have, and this is what I wanted to tell you about when we started out at the 100,000, the guy we've been telling you about, they were taking very low W-2,
Mm-hmm.
but he was making so much in his business that, and his advisor was bringing back 20 and 30% returns. And we kept saying, we need lower returns if you want to, make contributions to reduce your taxes. I finally got him to bump up his comp. And all of a sudden, instead of being able to put in 200,000 or 300,000 a year, he had years where he could put in, like we said, 1.2 last year, 1.7 this year, because he did that and opened up that ceiling for himself.
It's always the last 3 years that they're looking at on comp. Is that what they're doing, or?
No, it's the highest 3 over the whole time horizon. So it's as we go. So, in 2023, if we've had a plan for 10 years, what was their highest consecutive 3-year period in that last 10 years? That's one of the drivers. Okay. And so when we're getting that across is you're telling me you want to contribute more and take a bigger tax deduction, but you're not taking enough in pay to make that possible. Your limit, his limit was way down here, like what we were looking at a minute ago. Bump that up, and all of a sudden he's got room. Not only that, we did it for him, his wife, his mom. They're going to be able to end up putting away about $10 million in the end. They're at 6 right now.
And that's between the 3 of them, though.
That's between the 3 of them.
Yeah.
That's right.
And mom's, obviously, she's older, so she's going to have a much shorter time horizon. How many years is she? Right. How many years of funding is she doing?
She will probably be in for the next 7 years still.
Okay.
Yeah. And so they're young, but as long as they have her in the plan, it helps them as a family group. But that's a case in point. You said spouse a minute ago. If you have a business out there and it's owner only, and the spouses can work together, this limit is just you. Your spouse could have the same limit given the same parameters, right?
Yep.
And so it's really a big play on that.
So the easiest way to look at this, let me just take it home, is if you are a small business owner and you have active income, this is for you, right? This is somebody who's taking a salary, and it might be that they are either sole proprietor and it's all hitting them. It's W-2 out of an S Corp, W-2 out of a C Corp. Is it even if you have a job, like a regular job from somebody else, do you add that compensation, or do you just do it off the business that we're running the plan on?
It's their business income.
It's their business income. So if you're somebody that has a business, so this is going to be a business owner that is making greater than, is there a magic number? Do you say like
$400,000 worth of income is about the minimum, which equates to about $75,000 in tax liability.
Yep.
So if you're there, that's the best starting point to start looking at this, because anything less than that, you could probably handle the vast majority in a normal 401k, and we pair this with the 401k, so you can still build both buckets.
And it could be 400,000 or the ability to pay 400,000, because a lot of these people, obviously, like if you're in an S Corp, you may have $1 million coming down. You're paying yourself 2. You could bump that up to 4 and start getting some serious benefit.
And again, we do that strategically. I mean, we have an algorithm that determines on that case what is best for them, instead of, hey, because everybody else out there is telling them this. Hey, you have to put in these high amounts every year for the rest of your time to retirement. It's not true.
Yeah, and I'm looking at it. I'm thinking of a few clients, some C Corps too, where they're being gingerly with the payroll because they like that 21% in the corp, and you're like, hey, here's an easy way to get it into a tax deferred vehicle so that you can build up your retirement over the next 10, 15 years, right?
Right.
All right, gentlemen, I will put up, here's an easy one. If you guys want to have talk to Jeff and Chris and see whether or not this makes sense, just type in retire into the comments and we'll send you a link. Type in retire into the comments and we will send you a link. If you know of anybody that you think would benefit, please share this. And of course, like and subscribe. So thanks, gentlemen, for coming.
Thank you so much for having us.
Yep.